4,330, 50. The key is it's holding. It's not going down. I think what is happening too is people that were long gold and short silver, because that's obviously been a popular trade, that trade is being unwound. And so that means that you have to sell your gold and buy back the silver that you shorted. So that's probably keeping a lid on gold. But gold's not going down because there is still substantial buying of gold beneath the market. So we have very strong support now, above 4,000 for gold. And we're not going to get anywhere near 50 on silver again. I doubt it. I mean, is it possible that we could go back down and retest 50 again? I guess so. But I think the odds are that we're not going to get down there. You know, the big story, I think, this week is silver. And we'll see what happens tomorrow. Tomorrow could be another big day. I think we've got an option expiration coming up. But silver prices hit $66 and I think 77 cents, almost $68. I mean, we closed last week, I think it was 62. Now, we're off the highs, but as I am recording this, Thursday evening here in Puerto Rico, but silver's above $65.50. I mean, we just broke through 50. Now, if you recall from what I was saying on my podcasts, I said that I expected silver to take out 50 because that was the big double top. And that once it did, I thought we would have a quick move up to 100. I didn't think we would hit 100 this year, but I thought we would hit it next year. And we're on track. In fact, it's actually moving up even faster than I thought. Now, I'm not surprised that this is happening. What's actually surprising to me is that it took so long for this to happen. I mean, how long was silver at $30 when gold was 3,000 and higher? In fact, at one point, it was not only 100 to 1, it was like 108 ounces of silver for an ounce of gold. It was extremely absurd. Now it's back, around 65 or something like that. It's still cheap. It's just not as ridiculously cheap as it was. But what's really been happening is silver is just catching up to gold, right? It's taken a long time, but now it's making up that lost ground quickly because gold hasn't really gone anywhere as silver's been rising, but it hasn't gone down.
For much of the past year, the gold-to-silver ratio reached extreme levels, exceeding 100 ounces of silver for 1 ounce of gold, historically abnormal territory. That gap reflected distorted positioning, not fundamentals. Gold held firm above $4,000 while silver lagged far behind. Now silver is catching up rapidly, even as gold remains stable rather than falling. This suggests a powerful repricing rather than rotation. One reason is the unwinding of popular institutional trades, long gold, short silver. As those positions reverse, silver demand accelerates while gold finds strong underlying support. This isn't excess, it's normalization.
Gold is around 4,330, 50. The key is it's holding. It's not going down. I think what is happening too is people that were long gold and short silver, because that's obviously been a popular trade, that trade is being unwound. And so that means that you have to sell your gold and buy back the silver that you shorted. So that's probably keeping a lid on gold. But gold's not going down because there is still substantial buying of gold beneath the market. So we have very strong support now, above 4,000 for gold. And we're not going to get anywhere near 50 on silver again. I doubt it. I mean, is it possible that we could go back down and retest 50 again? I guess so. But I think the odds are that we're not going to get down there. What's also been a bit surprising, but again, nothing surprises me, is that the mining stocks have gone nowhere this week. They've been steady. Even the silver stocks, even with this explosive move in silver, the silver stocks are not making new highs yet. And maybe, people are thinking that this is a fluke, right? That, oh, well, this is just some kind of speculative blow off. And so they're not paying up for these silver stocks. Well, they're going to, because this is not a speculative blow off. This is a long overdue catch up. In fact, one of the places where there isn't a bubble, I mean, there's so many bubbles that have been inflated by the Fed and its, loose monetary policy. The one thing that's not in a bubble is gold and silver. It's not even close. It doesn't even have any of the characteristics that would qualify it as a bubble.
Despite sharp price moves, gold and silver lack every hallmark of a speculative bubble. There's no retail frenzy, no euphoric media coverage, and no widespread leverage. In fact, compared to equities, crypto, or real estate, precious metals remain underowned. What we're witnessing is delayed recognition. Years of loose monetary policy inflated nearly every asset class except sound money. Mining equities reinforce this point. Even after silver's breakout, many producers remain stagnant, suggesting skepticism rather than exuberance. Historically, that disbelief phase comes just before capital floods in. If past cycles hold, mining stocks may be the next to reprice violently.
And so I think that a lot of the money that has kind of been on the sideline this week, kind of watching in disbelief as silver prices have surged, I think you're going to see a delayed reaction in those mining stocks. And I think they're going to soar to new highs before the end of the year. So I would encourage people tomorrow morning, I would be buying more of these stocks, or if you don't own them, buy them, or get into my gold fund, the Euro Pacific Gold Fund, EPGIX. Of course, if you buy that tomorrow, you get filled at the close, right? But that's still going to be okay, because I think the big moves, again, are going to happen next week. Just like, it started, just like I said last week on Sunday night. Silver gapped up to $3 on Monday. Had a big move, but you had all weekend to buy it. And again, you got to go to Schiff Gold and buy some gold and silver tomorrow, this weekend. Just don't wait till Sunday night, because that's when Asia wakes up and they start buying. You want to buy before they do that. Right? And I think with the thin holiday trading next week, we could see even bigger moves. We could see a bigger short squeeze. There's still shorts out there in silver, holding and hoping that the market comes down. But there could be an overwhelming amount of physical demand for this commodity that is in scarce supply. Trump declared it as strategic metal, silver, right? I mean, there's a lot of real industrial use. Big buyers need silver. And there's just not a lot of silver there. That is the problem. Now, it's not a problem for me. I own a bunch of silver. I own a bunch of silver mining companies, right? So do my clients now. But it's a problem for the people who they've shorted silver that they don't have. And good luck trying to get a hold of it. So I would be loading up on silver over the weekend, Friday, at Schiff Gold for physical delivery. And if you don't want to take delivery, you go to tgold.com and you can buy silver.
Silver isn't just money, it's an industrial necessity. From solar panels to electronics and defense systems, demand continues to rise while supply struggles to keep pace. Governments now openly classify silver as a strategic metal, underscoring its importance. Yet large paper short positions still exist, betting on price declines despite limited physical availability. That imbalance is dangerous. When demand shifts from paper to physical delivery, shortages become visible fast. Thin holiday trading and global buying, particularly from Asia, can accelerate these moves. A short squeeze in silver isn't theoretical anymore. It's a mathematical outcome if physical demand overwhelms supply.
Close to spot, and we store it for you. Eventually, we'll tokenize it if you want to withdraw it in the form of a token. But for now, you just need to get a hold of it. You got to own it. And we're working on the app, too. Right now, you have to go on a desktop. You got to go to or I guess you can access it through a phone, but you got to go to the website. But we're building now, and it should be up in January, a new app, one for Schiff Gold and also one for T-Gold, to make it easier to buy T-Gold and sell T-Gold. But ultimately, I want to have people be able to transfer their gold using their phone to other people who have accounts at T-Gold. So the gold can go back and forth. The silver can go back and forth. So it can be used as a medium of exchange, which is how gold and silver should be used. They are money. And this platform is going to make it a lot easier to use gold and silver, not just as a store of value, but as a medium of exchange, as money. And ultimately, we'll have the debit cards, the credit cards, the tokens, all this stuff is going to be built on top of this. But, the first stage is to get everybody onboarded and get the gold and silver purchased before the prices go much higher. So, do that at Schiff Gold and T-Gold. Now, we got some news that came out this week. We actually got a jobs report and an inflation report that we got. And the jobs report, I think, came out yesterday, right? So everything is kind of coming out at the wrong time, because of the government shutdown. But we got the November non-farm payroll report. Now, I take these numbers with a very, very small grain of salt, right? But we got 64,000 jobs created. That's not a lot of jobs.
While metals surge, official economic data tells a conflicting story. Job growth remains weak, unemployment is climbing, and manufacturing continues to contract. Even with optimistic forecasts, recent payroll numbers barely clear the bar, and revisions historically move lower. Federal Reserve officials themselves have acknowledged that headline job figures are overstated. Inflation reports show modest monthly increases, but that relief is fragile. Higher tariffs, rising input costs, and slowing productivity all point toward persistent pressure on consumers. In this environment, precious metals aren't reacting to hype. They're responding rationally to deteriorating economic foundations and declining confidence in policy narratives.
And the forecast was 40,000. That's also a pretty low forecast. So I guess people focused on the fact that we had a really low bar and we cleared it. But I doubt we cleared it. By the time they revise this number, I expect it to be negative. Now, where we did get bad news officially was on the unemployment rate, which ticked up to 4.6%, which is like a 4-year high. So this is the highest the unemployment rate has been since Trump's been president. And of course, this doesn't capture all of the people who are unemployed. In fact, when Trump ran for president the first time, he was honest about how dishonest these numbers were. He said the unemployment rate was fake. When it was, 5%-ish under Biden, he said it was really 20%. Well, the same applies now, right? Donald Trump said all the numbers were fake until he was elected, and then they were real. Then he touted the numbers that he claimed were fake when Biden was president to show how great the economy was when he was president. Well, the numbers are either fake or they're real. They're not fake under Biden and real under Trump, but according to Trump, they were, right? That's how he rolls. And I'm going to talk a little bit more about the talk that Trump gave last night of the fantasy description of the U.S. economy after I get finished going over these numbers. But so the unemployment rate is 4.6 officially. Unofficially, it's a lot higher than that. But the direction is also important. Unemployment is rising. It is not falling. And manufacturing, even there, the payrolls dropped another 5,000.
Beyond price action, something bigger is unfolding. The remonetization of gold and silver. New platforms, digital storage, and tokenization are transforming metals from static assets into functional money. The long-term vision isn't just preservation of wealth, but usability. Transferable gold, spendable silver, and systems built outside fragile fiat frameworks represent a return to monetary fundamentals. Historically, precious metals regain prominence not gradually but suddenly. The first step is ownership before accessibility becomes crowded and expensive. If this cycle follows precedent, today's prices may soon look like the calm before a much larger monetary reset.
After dropping 6,000 in October. So the president is claiming that all of this investment is coming, all of this reshoring, all of these factories and production, it's all coming back, right? Because of his wonderful tariffs that are making us rich. Yet manufacturing continues to contract. People continue to lose jobs in manufacturing. So none of this is happening. This is all a fantasy. All the tariffs are doing is making the stuff that we import more expensive. And they're also allowing companies that produce some of the stuff that might compete with the imports to raise their prices too. So that's all Trump is accomplishing with the tariffs, is higher taxes and higher prices. That's it. We're not getting rich. We're not revitalizing our manufacturing. Nothing. And the numbers, as, rigged as they are, I guess, bear that out. So we had a weak jobs number. Private payrolls up 69,000, almost the same as total. So, not a lot of government. I mean, at least that's one good thing. Maybe the government lost some workers, which is a positive, but it's still a slowdown from the prior month. And again, I don't even believe these numbers. Nobody should believe these numbers. They're going to get revised again and again. And we know the direction that the revisions are going to come in, and that's down. And in fact, even the Fed, Powell admitted at his last press conference that the numbers are exaggerated and that they're probably always maybe 60,000 less than what the government claims. And if that's the case, they claim 64,000. So that's pretty much a push, meaning no jobs. But again, I still think it's going to end up being job losses. Now, today, we got the CPI numbers. And a lot of people want to celebrate these CPI numbers because they were lower than expected. So prices rose by 0.2 for the month. And that was better than the 0.3 that was expected.